Hello everyone, this is Mike DiSabato from MSCI ESG Research. Thank you again for attending the 2022 ESG Trends to Watch webinar in January of this year. We received a lot of really interesting questions from the audience that we weren't able to answer, so I decided I would record our authors Linda Ealing-Lee and Megan Eastman answering some of the more engaging ones. To start us off though, here's a quick message from Linda. We hope you enjoy.
Hey, Mike, before we jump in, I did want to say that we decided to put on this bonus segment, which we hadn't before, because, typically an event of this size where we have several thousand people dialing in, the questions we get can be kind of random and maybe not that interesting to the wider segment of the people who are dialing in. But I think in this particular case, we were just so impressed by the level of knowledge and sophistication on ESG and climate expertise that we really thought that all of the questions and hopefully our responses will be relevant to everybody who dialed in. So I do want to give a special thanks to everybody who submitted questions during our session.
Right, thank you for that, Linda. And now let's get to the first question. What is your response to the articles calling ESG a mirage?
Well, I thought that something like this question would probably come up. The article that is being referenced called into question the usefulness of MSCI's ESG ratings for furthering the goals of sustainable investments. And I think MSCI has already published a number of statements on this, so certainly if you're interested, you should go and take a look at those. My personal take on the article really kind of boils down to, well, number one, I call it a willful misunderstanding of what MSCI's ESG ratings actually aims to measure, which I think we've always been very, very clear about. And then number two, I think that the article actually just hugely discounts the very real and measurable benefits to society when companies improve their own bottom lines, not by taking shortcuts at the expense of their employees or their community, but by actually addressing those social and environmental issues in the way they run their businesses. So when it comes to this misunderstanding, I think that the article headlines it as some sort of a big reveal or kind of a gotcha that MSCI's ESG ratings aims to measure how resilient companies are to the financial risks that arise from environmental and social issues. And that is not actually a rating on whether a company is aligned, for example, to a net zero economy. MSCI has almost 1,000 climate metrics that are being used by our institutional investor clients precisely to help them measure companies' alignment with their climate goals. And so they're using ESG ratings to help them identify companies that are better at managing their financially relevant ESG risks. Plus, they're using MSCI's climate metrics that best let them kind of capture their own set of climate-related concerns, which might be different from one investor to another. So these are not mutually exclusive things, and I do feel like it needs to be said that investors and all investors can actually walk and chew gum at the same time, and they do. So as an aside, because I can't help myself to add this part, I just have to take the opportunity here to give a bit of a shout out to the person who actually asked this question on the webinar, which was Houston Balsall, one of my personal heroes in the ESG space. So Houston Balsall, alongside Matthew Kiernan, had founded Innovest in the 1990s. So this is a very long time ago, last century. And Innovest was invented what is today MSCI's ESG ratings. And I think their singular genius, if you don't mind me calling it that, was to focus large, influential investors in the world on the fact that mismanaging key ESG issues can actually impact companies' financial performance. I actually wrote an article on this origin story with Professor Bob Eccles and Dr. Judith Stroller, and about how important that was, for mainstreaming of ESG that we see today. So, MSCI has not actually deviated from that goal of designing our ESG ratings to capture the industry-specific set of ESG issues that can impact the long-term risk and performance of companies. So I think we've been very, very clear about that. I don't really understand why there's some sort of misunderstanding about it. And then I think on the second point, and I think this is a very important point to debate, I think, for the industry as a whole about a better world, are better ESG rated companies better for the world? I think this criticism that if companies are only managing its financially relevant ESG risks and issues, then it's not really actually doing anything to have a positive social impact. I would really take issue with that. I think that people should go and look at the long track record for over thousands of companies that we can see now. And if you care about this question seriously, I think you should go and look at the data for yourself. The truth is that companies that have been better rated have on average been more carbon efficient. They have faced fewer negative events like accidents and bribery incidents, and the taxes that they've paid indicated less accounting gimmicks. So these are all just sorts of measures that most people would agree, I think, make for a better world.
Next question. Do you feel that, for example, the EU regulations tilt the sustainability discussion overtly strong toward the E angle of ESG, thereby foregoing the relevance of the two other pillars?
So I think the short answer here is that there's more focus on E. It's true. But because there is more consensus on what aspects of E matters, namely climate risk, and how to actually measure it. I think climate change obviously is more important because it poses an existential threat and a systemic risk, and it's we're not moving nearly fast enough to address it, and that's why it has this regulatory focus. But it really is, I think, that the fact that there's some consensus, given that the TCFD has established a framework for reporting that allows most of the regulatory bodies, including the EU, to reference that as a baseline or a jumping off point for regulation. So it does seem like E right now, and particularly climate and climate related disclosures kind of dominate. But make no mistake, I think that the EU Sustainability Finance Initiative really aims to be pretty far-reaching, and I have no doubt that in time it's going to touch much more than just climate or just the E angle. It's just that for now, the social and governance aspects are a bit overshadowed, and I think different jurisdictions have different ideas about what aspects of S and G should be prioritized, so it's going to take a bit longer time.
Next, is there a risk with TNFD, that's the Task Force on Nature-Related Financial Disclosures, that we ask companies for disclosure, governance, etc., while what is needed is action?
There's no question that action is needed. But it's hard to act intelligently and strategically if you don't take stock first and do the work of measurement. And without the reporting and governance, it's hard for investors or outside stakeholders to assess whether a company understands its risks and impacts, much less what it's doing about them, and whether what it says it's doing is credible or appropriately aimed.
How effective are ESG ratings at addressing greenwashing?
Well, I think it depends on your definition of greenwashing. If you think greenwashing is, when a company says one thing and then it does something else, then I think that ESG ratings can be very effective at addressing that. And that's because MSCI's ESG ratings, it's not just a summing up of what the company is actually saying and discloses. It's not like I'm giving you a bonus point for everything that you say. Half of what actually determines a company's rating is actually based on other sources of data, other types of data, from government databases, for example, from NGOs and media sources, and that allows us to assess a company's risk level, its propensity to experience a problem. It also allows us to verify from these different third-party sources whether there are issues that are not being self-reported by the company. So I think that having this wide range of data sources is actually incredibly important for countering greenwashing, if that's your definition. Now, if your idea of greenwashing is, if a company or a fund has involvement, for example, with fossil fuel production or with industries that are high emitters, then no, I think investors don't need ESG ratings to tell them that some industries are dirtier than others. Investors actually use our ESG ratings to rank companies within an industry. So that means even in the energy and the mining industries, you're going to have higher rated and lower rated companies. So don't make the mistake of thinking that a AAA rated, that's our highest rating, AAA rated mining company and a AAA rated pharmaceutical companies actually have, for example, the same quote unquote greenness. If your idea of greenness is about fossil fuels.
Keeping with the theme of greenwashing, what is MSCI planning to do to address the greenwashing issues with some of their own indexes that are used for funds that include oil and gas entities?
So MSCI produces something like 2,000 ESG indexes. These are equity and fixed income indexes. Some of those indexes explicitly exclude oil and gas companies. We call those indexes, for example, the MSCI World X Fossil Fuels Index. And many of our ESG indexes also reflect many other elements of E, S, and G factors. And that's because investors ask for them. We produce indexes to client demand. So, I think that if you were looking at some of our women's leadership indexes, they are composed of companies with stronger female representation in every industry, and that does include energy companies and energy industries that happen to have stronger female representation. In our webinar, we did talk about the language and the need for precision in the language. So if by greenwashing you mean that any company or fund that isn't purely renewable energy and zero waste, then I do think that the corporate and the investment landscape doesn't really then meet that test.
Next question, what are the strongest counterforces to net zero goals?
There's a lot here, but I'll just say a few things. First, I think one of the things that all parties are going to have to work very hard at is to resist the temptation to get creative with their accounting, whether fundamentally or even just around the margins, to make the numbers look that little bit better or the improvements that little bit more impressive. A second fundamental challenge is to keep a close focus on the long-term goal and go into the journey with an extremely clear expectation that there will be short-term trade-offs. And extremely clear communication about that, whether to shareholders or employees or end savers. Everybody is going to have to do things that might seem painful in the short run, and that's hard. It will take serious discipline to stay on the right path. And then finally, I would just mention the challenges of data and measurement, especially around Scope 3. There is a lot of hard work to be done here, and again, there will be temptation to defer some of the action while that work's getting done.
The current definition of being net zero discourages companies from helping towards the conservation of forests, and this is a problem for biodiversity. Do you expect this definition will be changed in the future for better alignment?
One of the very clear messages that came out of COP26 was the essential role of nature and biodiversity and forests for dealing with the climate crisis. So I do think we'll see these two conversations much more closely intertwined in the future. And in fact, on the webinar, David Craig from the TNFC made exactly this point. But this also raises the questions of offsets and carbon markets. There's a huge amount of potential there, but at the moment, there are a lot of questionable offsets out there and not a lot of great options for assurance. Now, if the next few years play out well, I would hope to see the development of credible standards and a highly functional marketplace that contributes meaningfully to the preservation of nature and carbon sinks. But there's a lot up in the air in the meantime.
Moving away from net zero, another question asks, some sizable institutional investors invest in alternative assets through fund investment. What is the ideal way to engage with fund managers' ESG investing strategy?
I think investors' engagement should focus on transparency of the investments themselves. So asking fund managers for comprehensive, systematic measurements of all the investee companies in a fund. What is the carbon emissions of every company in a fund, for example, rather than just the processes or the policies of the fund manager. It's not really that many companies in a given fund. So certainly, compared to the publicly listed universe, I think fund managers with private companies, they have direct control and access to those companies. I would point out too, like on our webinar, Elizabeth Seeger from KKR, I think she alluded to the fact that the LPs in their funds do already engage them on ESG issues, and so I think that the first port of call really is that transparency piece. So on the one hand, obviously, private companies held by private equity funds are really far behind many of the public companies on disclosure on ESG issues. You are seeing more and more of these bigger funds starting to put more measurements in place. So I think it's still very much a patchwork or work in progress, but what I would say is that you really need to focus on the funds, the companies in the funds, in terms of any kind of engagement with managers of private equity funds.
For this set of questions, it was a collaboration of many different listeners that had thoughts on Scope 3 emissions. They focused on the market expectation for a company to disclose every applicable Scope 3 category, regardless if some of those emissions represent less than 1% of its total Scope 3. They asked about questions around the calculation of Scope 3 emissions, how it's notoriously difficult to calculate Scope 3 emissions. The general theme was around why Scope 3 emissions are such an important thing for investors to know and companies to report. And here's what Megan had to say about that.
At MSCI, we've come out strongly in favor of having all companies report all scopes and all categories of Scope 3. So yes, Scope 3 is difficult. It requires a lot of estimating. And yes, if we could just get the power sector globally to massively reduce its emissions, that would definitely help everybody. But A, the climate crisis is an all hands on deck kind of problem. And B, Scope 3 emissions can be highly material. If you don't measure or report them, you don't know what kind of risk profile you're looking at, and you don't have the information you need to start managing them. And as for why we feel strongly that companies should have to report all 15 categories of Scope 3, it's because you don't get comparability without that. If a company doesn't report a bunch of categories, there's no way to know, if you're an investor, if that's because they've measured those categories and the emissions are negligible, or those categories aren't applicable, or maybe just they're hard and the company hasn't gotten to it yet. So you could see two similar companies that could easily pick different categories, and an investor wouldn't know why and wouldn't be able to compare those companies. So piecemeal reporting basically just isn't that useful for this case.
Can you comment on the Green Century proposal to Costco that included Scope 3 that just received nearly 70% approval vote? Does this majority vote show that mainstream investors are taking climate more seriously, or do you have another take?
Right, so this was a shareholder proposal filed by the investment house Green Century, and it was voted on a few weeks ago. The proposal asked Costco to set science-based targets to reduce its emissions from its full value chain. And according to Green Century, this was the first shareholder proposal that went to a vote asking for this type of target setting. And while I don't have a crystal ball to say what this means for the future, that 70% approval figure is definitely striking. So that's an interesting shift and sign of progress in the direction things may be going, because it wasn't that long ago that most shareholder proposals on climate change were just trying to get companies to report emissions. And I think this speaks directly to the questions earlier about Scope 3 reporting as well, because you can't set, much less meet, a proper net zero target if Scope 3 is a blind spot for you.
Next question, what are the specific and mandatory regulatory reporting frameworks or standards on sustainability to be reported by banking institutions in the future?
All right, there is a lot going on for banks. First of all, depending on the jurisdiction, many of them are going to be just subject to the reporting requirements that apply more broadly across financial institutions, not just bank, and across all industries. So we talked about quite a number of them in the webinar, but I also encourage you to go and just look at the table that's in our ESG Trends to Watch report, and actually on our website, you'll be able to see that much better, which is a longer list. In terms of the frameworks, there is a big focus on the TCFD as the baseline framework for climate reporting. And of course, in the EU, the Sustainable Finance Initiative, which continues to evolve and develop, it has very detailed reporting requirements. But in addition to these requirements that apply broadly to other industries as well, specific to banks, more central banks are exploring or instituting climate stress tests. There were a number of large banks that participated in the Bank of England's climate stress test last year, and the Hong Kong Monetary Authority also conducted one. Now the European Central Bank just kicked off climate stress testing for its supervised banks. There is a template, actually, you can go and download off of the ECB's website to see the data inputs that are required. In the US, there is currently a consultation from the Treasury's OCC is the Office of Comptroller of the Currency. They've also just issued a consultation that would pertain to large banks, which will seek information on how banks actually monitor and measure their exposure to climate risk. So there's a lot going on for banks, in particular, in addition to what's going on for other industries, and I think that there's going to be more to come.
Keeping with regulations, could you share some thoughts on the upcoming ESG integration into MiFID II? Are market data providers prepared to provide all necessary ESG data points that includes SFDR, EU taxonomy, PAI, in time to meet those requirements?
Yes. So, I can obviously only speak for MSCI, but we're certainly in a position to cover the three parts of that MiFID II introduced into sustainability preferences. We have a large pool of data and models available that investors can choose to map out their client preferences as aligned to the EU taxonomy, the sustainable investment criteria, and the principal adverse impact criteria. Now, there is a fair bit of uncertainty actually around how to apply the data to define the specific thresholds. And so that's an area where we're very active both in monitoring the evolving EU initiatives and also improving the data set to match those developments. But in addition, we are conducting workshops with some of our largest clients in Europe to help develop options for applying that data so that they can kind of report appropriately. If you have questions about what's available, what are the available data and options to meet the MiFID extension, please do follow up with our client consultants team. They are very active in this space at the moment.
Another question, some ESG ratings organizations offer consulting services to improve their rating, e.g. some of our competitors. Doesn't this harm the credibility of ESG ratings? Do you think this inherent conflict of interest will be regulated in the future?
Just to be very clear, MSCI's business model is that we're a subscription research business and almost all of our clients are investors. We do have some clients who themselves are consultants to companies on sustainability strategy, but MSCI does not have a corporate consulting practice. We don't tell companies how to improve their ratings. Now, so is this space going to get regulated, especially some of these areas around the conflict of interest? Well, there's clearly regulatory interest in understanding this ecosystem of providers of ESG data, ESG ratings, and IOSCO, for example, has issued some recommendations on that, or at least some consultations and then some follow-up on that a few months ago. I don't really know how the regulatory landscape will change, but in general, we are certainly very supportive of measures that promote best practices among providers in their transparency and their governance processes.
This is another compendium question. As companies start setting their decarbonization goals, how do they start accessing lending benefits, i.e. green bonds? And how do we expect ESG impacting the whole lending space and especially the credit risk processes? Basically, this is about lending and access to capital in the green space.
Green bond issuance is definitely one of the tools available to companies looking to access the capital they need to achieve their decarbonization targets. But increasingly, there are other options available as well. In fact, we wrote about this in the 2020 ESG Trends to Watch, which you can still find on our website. And the title of that trend was New Terms for Capital. And we wrote there about things like sustainability-linked lending, where access to more favorable loan terms is tied to achieving ESG goals, like, for example, decarbonization targets. Now, the question of credit risk processes specifically is an interesting one. We have been seeing the credit rating agencies leaning into ESG in recent years, but their approach is still pretty closely tied to specific timelines and issuances rather than whole companies. So it remains to be seen how that's going to play out going into the future.
Here's a question for the history buffs. In 1999, MSCI developed CIGS. Do you think this classification is still valid for, say, assessment of temperature of a portfolio, and how does it take agriculture into account?
I think this is a great question. We do need to clarify something here. The CIGS classification is what we at MSCI use to categorize companies by industry so that they can easily be aligned to the way an investment portfolio, for example, categorizes industries and sectors. However, that's not really the same as how we break down companies, industry, or business segments, within our ESG models or climate models. So for example, when we measure or model the exposures of individual companies to different types of environmental, social, and governance risk issues that are in our ESG ratings and in our ESG ratings model, we're breaking down their business segments into much more granular segments than the CIGS can, and that maps to over 1,000 business activity categories. And as the question was asking about temperature, as in the implied temperature rise model, we allocate companies companies an overall company-specific carbon emissions budget for each company based on the sectors and the geographies of that company's revenues. And so these budgets are actually allocated by what we call emission sectors. It's not actually by GIGS classification. So these emission sectors are a classification of activities that we've designed, which are more granular for carbon-intensive activities and that are more aligned to exposure to climate policies. And yes, agriculture is certainly one of those sectors. Actually, there are a couple of different sectors that pertain to agriculture in our emissions sector classification that we use in the climate models themselves.
Moving on to antibiotics, didn't the COVID crisis lead to greater use of antibiotics in cleaning products, adding to the bacteria rising problem?
That's actually one of the questions we started with when we began fleshing out this trend, and we had some lively internal debates among our analyst team on this very point. The upshot from the research is basically that, yes, there has been much increased use of antimicrobial cleaning products during COVID, but still their overall impact to the problem of antimicrobial resistance is still dwarfed by what goes on in the meat industry.
Last question. A couple of companies wrote in with a question about how to interact with MSCI ESG Research, how to share new information with us to get corrections made, just generally how to communicate with us better. Here's what Megan had to say about that.
So first, we're really thrilled to see how many issuers joined the webinar, and I hope very much that it was useful to you. If you've been trying to get in touch with our issuer communications team and are getting frustrated, I am sorry. We did receive somewhere north of 23,000 inquiries from issuers last year, and it's all we can do to hire people fast enough to keep up with the communications, which we hope will continue. Please do contact the team again at esgissuercom@msci.com. That information is also in the email you've received. And ask for access to the Issuer Communications portal, where you can see all the data that we have on your company and submit questions, corrections, and updates. And also, I should mention that there are lots of resources and FAQs for issuers on our public website as well.
Okay, so that's it. Thank you all again for your questions, for joining the webinar, and for engaging with our trends and further research on MSCI.com. If you need any further clarification or want to know more about anything we do at MSCI, don't hesitate to reach out. Remember, our trends paper and blog is available on our website. You can just search MSCI 2022 ESG Trends, and you'll find it and a lot of other great information. Thanks, and have a great rest of the year.